Welcome to the fifth podcast. It is December 26th, 2014. We're just going to have a quick look at the usual six main US indexes and let's go. So S&P weekly gain almost 1%, new high of 2092. 2100s are coming, whether it's before year end, just 3 trading days left of 2014 or early January. Shouldn't make any difference to anyone who's long. The only issue is now what sort of minor pullback are we going to get in the next down wave, which probably isn't going to last more than a couple of weeks at most, and it's probably not going to be anything more than 3 to 5%. The usual nonsense that we've had for the last 3 years or so. Now, the real bigger issue is what about upside for the spring, the summer, and even for next year? I still haven't finalize my best guess for the end of next year yet, but it looks like we're going to be at least 2500 S&P by the summer. Now, whether that's June, July, August, or even September, does it really make any difference on the time scale now? It's like the broader trend is strongly higher, and if you factor in other indexes, not least the Russell, then the S&P along with the broader market is going to keep pushing higher. Next up, Index 2, Nasdaq, which, now we're only just under 7% from the tech bubble high of 5132. And it does seem likely that we will hit that level sometime by the late spring. Of course, that's going to get everybody really excited. No doubt some of the Doomer Bears will be coming on out and calling, oh my god, we're going to get stuck in the 5,000s and then we're going to crash. But that doesn't seem to make any sense considering the bigger picture. For me, what I'm going to be looking to see is a monthly close in the 5,200s or higher. Once we see that, it should be a straight run to 7,000 or so. But of course, that's a pretty monumental 46% higher. Index 3, the Dow. So, another 248 points for the Dow this week. New highs, weekly, monthly charts are offering 18.3 to 18.5 by next month. More interestingly, we have a Fibonacci level of 18.9, which of course is quite a way up, but that seems more likely in like February, March time rough. Certainly, January it's out of range. And then of course, once you get past 18.9, the next level is roughly 20k. Of course, that looks out of range until the summer. But still, primary trend is up. 4, NYSE Composite. So the main index gained just under 1%. We did break 11,000 on Friday, although we closed under it. Not that that should be anything deemed as bearish. Looks like we're going to go to the 11.3s before the next opportunity of a downwave. I suppose it could be even a little bit higher than that, but 11.3, that's another 4% higher. Okay, now the big issue of the week, in fact the month, and even you could argue that it's the biggest issue of the entire year. The Russell has finally taken out the double top of the year of 1212/13. We even got a weekly close above that, which is kind of a bonus for anybody looking for real confirmation. We've now hit 1217, which in my view is decisive enough. Looks like in the very near term, we're probably going to go to at least 1250, maybe 1275 by early February. It depends on when the next retrace is. If the current wave drags out into February, which is possible, then we're probably looking at 1260s, 1270, somewhere around that. Now, on any basis though, even after a retrace, we're still going to go into the 1300s. And I've already seen a few other people looking at the 1400s for the Russell by the summer. And it doesn't take much of a stretch to then assume that the 1500s are going to come at least by the end of next year. But to me, the bigger issue is the price structure and price action in the Russell is exactly the same as the transports in 2012. And if you look at what the tranny did when it broke out in early 2013, it's almost doubled up since then in basically, best part of 2 years. I realize it's going to be absolute crazy talk, but, the Russell R2K at 2K within you know, 18 months or so is possible, as crazy as that sounds. Index 6 transport. So it's leading the way up 2.3%. We haven't broken a new high, interestingly, but that's partly because the transport's got extra whacked down recently. Does look like we're going to be hitting the 9500s next month, or certainly by early February, and then maybe the next retrace will be on the order of 4 or 5%. So it's pretty reasonable to say that probably the 9,000 level will hold for the transports in the next wave lower, and then from 9,000 we should be going up to at least 10k by late spring or so. This is a sub issue with the transports in that as oil prices go up, which I'm assuming they will, I think they floored last week. The transports has got a lag because, you know, obviously if stocks like airlines are they're going to be held back, but it does mean that the transports has got a lag, certainly relative to the Russell and probably almost all the other indexes. So 2 weeks to the upside, and we're just storming upward, aren't we? I mean, where is it going to end? I mean, I'm well aware that there are a huge number of crash maniacs ready to call a crash wave starting from January. Now, in their defense, they're not calling for a crash in January or even February, but they're looking for significant downside, and, you know, from there, a consistent broad-based downside into the spring, maybe even the summer and beyond. But come on, we're probably almost certainly going to get a little minor pullback of 3, 4, 5%, whether it's late January or February, makes no difference. And then off we go again, 2300s, 24, 2500s, and then you got to start to see the mainstream start talking about S&P 3000. I did see one analyst on Clown Finance TV this year talk about S&P 3000, but I think his time frame was like 3-4 years out. But that was the only one I'm aware of. As for next week, it's going to be a short week. There's absolutely nothing on Monday going on. Tuesday, pretty much dead. Wednesday, we do have a PMI number, which is kind of interesting, and the jobs data is brought forward. But then, honestly, who cares about the weekly jobs data anymore? I mean, very, very few. It's you know, there was a time when the jobs data actually meant something, and now it's so people just don't care. Thursday, of course, is closed for New Year's Day, and Friday is the first trading day of the new year. And then before you know it, on Monday, January the 5th, things will really start to feel like a brand new year. Now, two big issues I think there still are. One, interest rates. Now, of course, Yellen has been alluding to the fact that rates won't be going up for at least a, quote, couple of FOMC meetings. That probably gets us into at least March, if not April or May, FOMC. But I got to think that we're going to see a rate rise of a quarter point somewhere between either March, April, or May. And if they do it in May, of course, that's technically, well, cyclically when the market generally kind of peaks, late spring, early summer, and then a little minor down wave. So it really, the next moderate down wave of maybe, you know, 5, 6, 7, even 8%, it's going to be dependent upon when the Fed raise rates. Because once that first rate rise is out of the way, the market should rally. Always tricky to guess what those maniacs will do, but we're probably going to see a minor rate rise. Depending on what point in the equity cycle that the Fed announced a rate rise, you know, the market could retrace 5, 6, 7%. But even then, once that is out of the way, once the market has decided, oh yeah, we can cope with increased interest rate rises, then market's got to rally again. Second issue is, again, oil prices. Huge issue. Of course, the main market is rallied to some degree on the fact that oil prices have dropped, which of course is going to help almost every single sector, aside from energy, ironically, of course, that low energy prices are a good thing. There's that. Now, I'm guessing oil has indeed floored at 53.60 with a micro double floor from last week. Now, first target is arguably somewhere in the low 70s. Now, that's clearly going to take a good couple of months to get up to $70 or so. From there, my best guess is that we will roll over again. We'll have another wave lower into summer and the latter half of next year, probably maybe down to 50, if not the low 40s. Now this is all bullish, of course, and I realize, of course, that's not what many of you want to hear, but that's how I see things right now. Under no circumstances am I getting involved on the short side in index shorts or VIX long. Seems a complete waste of time in my view, never mind money. It's just a case of taking careful longs, that even includes oil in some cases, and just being careful. We've got a short week next week, should be interesting, but overall there's nothing for the equity bears to get excited about at all. But no doubt they will be coming out of the woodwork when we're in the S&P 2100s in January, and it's a case of try not to get lost in bearish hysteria, which coming from me is of course ironic, but you know, there you go. So I should say good night from London.